Okay, hi guys. I hope you are doing well. Welcome to the session. So I'm just going to start off the session and let me just share with you the agenda that I'm going to follow for the session of today. ACCA has uploaded mock examinations on their portals. So what I'll be doing is that I'll be using the CB practice platform and I'll be using the mock examination that ACCA has given. Although this mock examination may have got some questions which are adapted from the previous past papers. But again, what we would be doing is that we'll be going through this mock examination so that we could do whatever questions we can and we'll take it up from there. So let me just start off. I have assigned to myself the mock examination that ACCA has uploaded on their website. And I'm going to start off with that. Basically, this is the SBR December mock. And I'm just going to start off with it. You know this thing that the SBR paper has got a structure, which is you've got section A, 2 questions. You've got section B, which also has got 2 questions. So the section A 2 questions are like 30 and 20 marks each. And the section B question is like 25 marks each. So let's actually start off. The first thing that I'm going to do is that I'm going to talk about this section A. And the question that I have in front of me is about a group company, which is the Cameroon company. And there are multiple requirements to the question. So what I will do is that I'll discuss each one of them one by one. It says the question's requirement says draft an explanatory note to the board of directors of Cameroon company addressing the following. How the fair value of the factory site should be determined at 1st July 4, and why the depreciated replacement cost of 17.4 million is unlikely to be the reasonable estimate of the fair value. A calculation of goodwill arising on the acquisition of Macmillan Company, measuring the NCI at fair value and proportionate share. Discuss the calculation and allocation of Macmillan's impairment loss at 30th June 8, and why the impairment loss would differ depending on how the NCI are measured. Furthermore, there are this consideration for acquisition and so on and so forth. So there are multiple requirements to the question that are there. So what my approach is that whenever I read through the question, I actually copy the requirements so that I could actually paste them in my word processing document. So that I could actually do it on the word processing document. And then I could just go on doing this. I could just go on doing this, doing the calculations as and when they are needed. Now, so one of the requirements that we have is we have to talk about the estimation of the fair value. That's one thing. Second is we got to calculate the goodwill using the fair value method, using the proportionate share of fair value of identifiable net assets. So that's another thing that we have to do. The third thing that we have to do is that we have to discuss the calculations and allocation of Macmillan Company's impairment loss and so and so. Then we have to talk about another aspect, the consideration for the acquisition, how it should be accounted for. Then we have got this expense for the share-based payment transactions also. So there are multiple things to this question. Now let's just try to see that how exactly are we going to answer the question. So one is about the fair value. One is about the calculation of the goodwill. One is about the discussion and the discussing of the calculations and the allocation of the Macmillan Company's impairment loss and why the impairment loss would differ depending on how NCI are measured. Your answer should include a calculation and explanation of how impairment impact. Then it says discuss how the consideration for acquisition of a steward should be accounted for and so on and so forth. So let's actually discuss about this Macmillan company first. Acquisition is one aspect, impairment loss is another aspect. And then the third one of them is basically the acquisition of a steward company. Just a minute. Okay, now if I talk about this acquisition of Macmillan company, let's try to discuss this. Let's try to see that what exactly is the examiner up to on this. It says Cameroon company acquired 80% of the 5 million equity shares of Macmillan company on 1st July 2004 for a cash of $90 million. The fair value of the NCI at the acquisition date was $22 million. The fair value of identifiable net assets at acquisition was $65 million, excluding the following asset. Macmillan purchased the factory site several years prior to the date of acquisition. Land and property prices in the area had increased significantly in the years immediately prior to 1st July 4. Nearby sites had been acquired and converted into residential use. It is felt that should the Macmillan company site be converted into residential use, the factory site would have a market value of 25 million. 1 million costs are required to be estimated to demolish the factory and to obtain the planning permission for the conversion. Macmillan company was intending to convert the site at the acquisition date and had not sought the planning permission at that time. The depreciated replacement cost of the factory at 1st July 2004 has been correctly calculated as 17.4 million. Now, my requirement to the question is that how the fair value of the factory site should be determined at 1st July 4 and why the depreciated replacement cost is unlikely to be the reasonable estimate of the fair value. So basically, this question is about IFRS 13. What are the things that you have to do? You have to first of all mention that fair value is the exit price. That is, it's the price at which assets could be sold or liability could be settled. The price is determined by reference to the most active market. In the current scenario, in order to determine the price, the best use basis is considered. In order to determine the price, the best use basis is considered. Right? So the best use has to be considered. Now, furthermore, What is it that we need to do? So basically what happens is that the fair value is the exit price. What is it? It's the exit price. It's the price at which the asset could be sold, or it's the price at which the liability could be settled. Right? Now what next is there? If I move a bit forward and if I discuss further, we would say that the property has been used. What is the major way? The factory side would have the market value of so and so, so and so, so and so. The property has been used as a factory site, but it could be legally converted into a residential property. Although entity has not converted this to a residential property, but this is legally permissible. Hence, the best use of the property should be residential, and it should be valued on this basis. Resultingly, the value of the property should be $23 million, which is being 24 million less 1 million, the cost to convert into residential use. So resultingly, the value of the property should be 23 million, 24 minus 1, the cost to convert into the residential use. That's something that you're gonna do. So the 17.4 million is not going to be the likely price, but in fact, the best use is to convert this property into the residential property. And if you have to convert this into a residential property, that is something that you have to do. Okay, now the second requirement of the question is, it says the calculation of the goodwill arising on the acquisition of Macmillan, measuring the NCI at fair value, measuring the NCI at proportionate share. So we are being given the fair value of identifiable net assets, excluding the falling assets. So what are we going to do now? We're just going to do the calculations. So if I could just open up the spreadsheet, I'm converting this spreadsheet to 200% so that you people could easily see this. Let's just try to do this thing. So you'd have the Macmillan company. The goodwill calculation. Number one of them is using the NCI at fair value. Using NCI at fair value. So that's the one calculation that we have to do. So we would say the cost of investment. We would say the cost of investment. The cost of investment is 90 million. The fair value of NCI is 22 million less fair value of net assets. Less the fair value of net assets. I'm doing A2. I'm doing A2. And when it comes to this, you would say as per question, fair value adjustment. So as per the question, it is what? As per the question, it is 65 million. Albeit as per the question, it is 65 million. And the fair value adjustment is going to be what? 23 million. So hence, resultingly, what happens is this is what you are going to get, 88. And the goodwill is going to be what? The goodwill is going to be 24. So the goodwill is going to be 24. That's one aspect of the question. That's the answer to the question 1. Now, if I move a bit forward and if I discuss further, the second requirement of the question is that you have to calculate the goodwill using NCI at proportionate share. I would just copy this down using NCI at proportionate basis. The cost of investment is this. Here what you do is that you say this multiply by 20% because the NCI is 20%. So hence what actually happens is that you get an NCI, you get a value of the goodwill to be, you get a value of the goodwill to be 19.6. I bet you get the value of the goodwill to be 19.6. Right? Okay, now the requirement of the question was that you have to perform a calculation of the goodwill arising on the acquisition of so and so, so and so. So I'm just going to write down as per the spreadsheet. I'm just going to say as per the spreadsheet. Now, if I move a bit forward and if I discuss further, it says discuss the calculation and allocation of Macmillan's impairment loss at 30th June 8 and why the impairment loss would differ depending on how NCI are measured. Your answer should include a calculation and explanation of how impairment would impact the consolidated finances statement. Let me just go through this impairment thing and let's just see that what exactly it is. It says Macmillan Company incurred losses during the year ended 30th June 2008. What happened? Macmillan Company incurred losses during the year ended 30th June and an impairment review was performed. The recoverable amount of Macmillan's asset was estimated to be 100 million. Included in this assessment was the factory site owned by Macmillan Company, which had been damaged in a storm and impairment to the extent of 4 million. Carrying amount of net assets, so and so, including fair value adjustment on acquisition, but excluding goodwill are as follows. None of the assets of Macmillan, including goodwill, have been impaired previously. Macmillan Company does not have the policy of revaluing the asset. So what is actually happening is that we need to do the impairment calculations. If I actually talk about the impairment calculations for it, if I talk about the impairment calculations, what is actually going to happen? Let's just try to see. For the impairment calculation, you would do this. You would say that if NCI is at fair value, the carrying amount of net assets is how much? Is actually going to be 106 million. Is 106 million. Then what happens is that you add goodwill to it. So how much is the goodwill? The goodwill is 24. The total carrying amount is gonna be this plus this. The recoverable amount is gonna be 100. I bet the recoverable amount is gonna be 100 million. If the recoverable amount is gonna be 100 million, the impairment loss is gonna be what? The impairment loss is gonna be this minus this, gives you 30 million. Gives you what? 30 million. Now, so basically what happens is that if this is how it is going to be, the impairment loss is what? The impairment loss is 30 million. Now the allocation of impairment loss is going to be like this. First of all, you would actually allocate it to the asset damaged. And we know that how much is the value of the asset which is damaged is, it's basically 4 million. It's about the factory side. $4 million. Then what happens is that you would allocate to the goodwill, and that goodwill is going to be 24 million. Then the balance amount is going to be what? Is going to be this. The balance amount is going to be 2 million. How much? I repeat, the balance amount is going to be 2 million. And when the balance amount is going to be 2 million, what is actually going to happen is that it has to be allocated to the other assets. You've got other plant and machinery, which is 15. You've got intangible assets other than the goodwill. Okay, sorry. So basically what happens is that now you've got other plant and machinery, you've got intangibles other than goodwill. So basically what would happen is that the balance impairment loss is going to be allocated to what? Other plant and machinery. The intangible assets excluding the goodwill. So resultingly what is going to happen is that the machinery is having a carrying amount of 15, the intangible having a carrying amount of 9. 15, this is basically 15. This is 9. So they both have a combined carrying amount of 24 million. Now what actually happens is that the allocation is going to be like this. This is going to be 15 divided by 24 multiplied by 2. And then this is going to be 9 divided by 24 multiplied by 2. So allocation is going to be like this. So if the NCI is at fair value, this is how the allocation is going to be. And I'll just repeat. If the NCI is at proportionate share, if the NCI is at proportionate share, so the goodwill, we already know the goodwill is going to be this 19.6. The recoverable amount is 100, but the goodwill of 19.6 is not going to be considered. What you need to do is that you need to actually have grossed up goodwill. The grossed up goodwill is gonna be what? The grossed up goodwill is gonna be this divided by 80%, because we need to have the total goodwill of the business. So hence this is gonna be what? This is gonna be 130.5. The impairment loss is this. Factory side 4. The goodwill is gonna be what? 24.5. And then you would have this 2 million. And again, it's gonna be allocated to these two. So resultingly, what happens is that if I could just see the, okay, 30.5 minus this. Okay. Now, this is an area where a lot of students actually struggle, but still, I mean, like, this is how the allocation is going to be. This is how the allocation is going to be. Same goes here also. Now let's try to discuss this. Let's try to understand this. For the calculation and allocation of the goodwill as discussed in the spreadsheet is discussed as under. For the NCI that is measured at the fair value, it's the full goodwill. For the NCI that is measured at fair value, it's the full goodwill that is calculated, and the allocation, and it's the full goodwill that is calculated. The impairment loss is first allocated to the impaired asset, and it is equal to $4 million. Then the impairment loss is allocated to the goodwill of 24 million. After the allocation of impairment loss to the goodwill, the remaining impairment loss just a minute, please. Okay, so basically the impairment loss, after the allocation of impairment loss to the goodwill, the remaining impairment loss shall be allocated to the other assets on a pro rata basis. The current assets are already recognized at the current assets are already recognized at the recoverable amounts. Therefore, no impairment loss is required to be allocated to them. Okay. The current assets are already recognized and therefore no impairment loss. For the remaining impairment loss after the allocation to the factory site and the goodwill, it should be allocated to the other intangible assets and it should be allocated to the other intangible assets and the property, plant and equipment on a pro rata basis. With respect to the calculation of NCI using proportionate basis, the goodwill should be grossed up before determining the impairment loss. Goodwill should be grossed up before determining the impairment loss. The impairment loss allocation shall be in the same sequence as the case is when the NCI is measured at fair value. However, the impairment loss allocated on the goodwill. However, for the impairment loss allocated on the goodwill, only 80% of it shall be recognized in the income statement, as only 80% of the goodwill is recorded. So that is how things are gonna be. That is how things are gonna be. Is there any question on this, please?
ओह हाँ वेरी गुड लेकिन ये यहाँ नहीं लगेगा ये रॉन्ग है ये यहाँ पे यूं करके लगेगा अभी इसको दूसरा लगाओ फिर बनाते हैं इसको ये क्या है ये यहाँ लगेगा हाँ बस तो ये लग गया अब क्या लगेगा ये देखो यहाँ लगा अब यहाँ बिग डॉग भी बनाओ ये बात यहाँ लगी
Let's move a bit forward and let's see.
हाँ
So we have done about this acquisition of Macmillan Company. We have gone through the Macmillan Company area. Now let's move a bit forward. There's this acquisition of Stewart Company. Let's talk what is going on with the Stewart Company. It says Cameroon acquired 60% of the 10 million equity shares of Stewart Company on 1st July 7. How much did they acquire? They acquired 10 million of the equity shares of Stewart Company on 1st July 7.
big one
2 Cameroon Company shares are to be issued for every 5 shares acquired in Stewart Company. These shares will be issued at the start of 1st July 2008. The fair value of the Cameroon shares was 30 at 1st July 7. Stewart Company had previously granted a share-based payment to its employees with a 3-year vesting period. At 1st July 7, the employees had completed their service period but had not exercised their options. So the employees had completed it, but they had not exercised the options. The fair value of the options granted was $15 million. As part of the acquisition, Cameroon is obliged to replace the share-based payment scheme of Stewart with a scheme of its own, which has the following details. So basically here what is happening is it's a replacement, share-based payment replacement that's actually taking place. So now when it is actually a share-based payment replacement that is taking place, how exactly are we going to deal with the situation? We need to discuss this. Now it says Cameroon Company issued 100 options each to each of the Stewart employees, 10,000 employees. The shares are conditional on the employee completing a further 2-year of service. Additionally, the scheme required that market price of Cameroon had to increase by this to 30 per share at acquisition date over the vesting period. It was anticipated that at 1st July 7, the 10% staff would leave over the vesting period, but this is revised to this. The fair value of each option at the grant date was $20. The share price of Cameroon at 30th June was 32, and it is anticipated to grow at a similar rate in the year ended 30th June 2009. Now let's just try to understand that how exactly should we be doing it. The requirement of the question is that how the consideration for the acquisition of Stewart Company should be measured on 1st July 7. Your answer should include a calculation of the consideration and discussion of why only some of the costs of the replacement share scheme should be included within the consideration. Okay, first of all, I'll just do the calculation with respect to this acquisition of Stewart Company. First of all, I'll just do the calculation for the acquisition of Stewart Company. And then I'm actually going to move forward and see that what exactly are the things to do. Now, let's just see. So the fair value of the shares to be issued you've got how many shares are going to be there? There is going to be 10 million equity shares. You've acquired 60%, and you will issue 2 shares for every 5 shares acquired. So for this, what do we need to do? We need to say that number of shares acquired is 10 million multiplied by 60%. Number of shares issued is 6 into 2 divided by 5. The fair value of the shares issued is 2.4 multiplied by 30. 2.4 multiplied by 30. Now, second thing is that fair value of the replacement award. So for the replacement award, what do we need to do? We need to see that fair value of the existing grant. You'd actually done what as previously granted share option to employees with 3 years vesting period. At 1st July, the employees had completed the service period but had not exercised their option. Fair value of the option at the grant date was $15 million. It was $15 million. Now, estimated fair value of the completed grant on the basis of new conditions is required to be estimated. Right? How do we actually estimate this? So basically, what are you gonna do? You're gonna say that basically here situation is 100 options granted to 10,000 employees, and that is for further 2 years of service, right? Additionally, the scheme required that market price increase by so and so, so and so. Okay, ignore this. This is a market condition. It was anticipated at 1st July 7 that 10% of the staff would leave. The fair value of the grant date was 20. So it's actually gonna be what? 100 options into 10,000 employees, multiply by 20, multiply by 3/5, multiply by 90%. Now why? Because 100 multiply by 10,000 employees, multiply by 20, multiply by 3 years, which is the vesting period for which it has already been met, and multiply by 90%. So hence, this is actually going to be what? Okay, in order to convert this into terms of millions, I would just divide it by 1 into 10 raised to power 6. So it's actually becoming 10.8 million this way. Now, if I remove this 3/5, if I remove this 3/5, so what do I get? I get 18 million. Now this 18 million is to be considered. I repeat, this 18 million is to be considered. So basically, fair value of the replacement award is 18 into 3 upon 5. 10.8 million is what is to be considered. So now when the question's requirement is that how the consideration for acquisition should be measured on 1st July 7, your answer should include a calculation of the consideration and discuss why some of the costs of the replacement share-based payment scheme should be included within the consideration. So how exactly are you going to do it? You're going to do it like this.
Where is the left? Turn. Yes. तो ये लाइन बन रही है स्ट्रेट, तो ये वाली स्ट्रेट लाइन इसके बराबर में आएगी, समझ रहे हैं, क्योंकि ये स्ट्रेट लाइन यहाँ आएगी बराबर में, बनाओ.
The consideration for the acquisition as explained in the spreadsheet includes fair value of the shares, to be issued for the acquisition of the company and the fair value of the replacement awards. The fair value of the replacement awards shall be determined on the basis of revised fair value of the grant.
Very good. And टोपी का दूसरा हिस्सा क्या है देखो. Can you see the other part of that? Is the other part? No, it's not. Okay. Now this is the other part. And wait for very good. डॉगी बन गया हाथ. अब क्या बनाना है? अब इसके आगे यहाँ देखो, यहाँ क्या लगेगा? ये देखो लिखा लगेगा. ये दर है टोपी के साथ. टर्न करो टर्न. सही है. अब टोपी क्या है इसके बराबर में, ये देखो ये डॉगी का ये वाला पार्ट आएगा. आएगा ऊपर. हाँ ऐसे. वेरी गुड. अब डॉगी का फेस टाइम देखो. देखो इधर डॉगी का फेस टाइम. देखो ये फेस आ रहा है. फेस को फेस के साथ इधर लगाओ ना. वेरी गुड. अब देखो नीचे क्या आ रही है, कार आ रही है. हाउ डू यू मीट द कार? नो, कार इधर लगती है, नीचे लगी थी ना यहाँ पर. नाउ टायर नीचे आते हैं. वेरी गुड. कार का दूसरा हिस्सा क्या है देखो. No, this is not the car. देखो ये भी कार का पार्ट है, ये भी कार का पार्ट है. नहीं, ये भी लाइन बन रही है. किधर लगेगा? हाँ वेरी गुड. इधर लगेगा. नहीं नीचे नीचे. तो कार है ना, देखो कार से ज्वाइन करो. ग्रे को ग्रे से, ग्रे को ग्रे कलर से मैच करो यहाँ पर. वेरी गुड. और साइन पार्ट है, ग्रे पार्ट का है. Very good. How, where is the gray part? Yes. And where you will match? Very good. Very good. Match it. Now where is the corner piece? Which corner piece will come up? Yes, this one. Very good. And it will come down. Which corner?
Yes, I will do that. Mara will do that.
Where down, corner, yes.
Now,
Now the last piece, where do you put it?
An estimate of the expected conversion is also incorporated. And on that basis, the value to be included
Where it comes from?
in the calculation of the acquisition consideration shall be 10.8 million. Now, last is that how much of an expense for share-based payment should be included in the consolidated profit or loss of Cameroon company. Your answer should include a brief discussion of how vesting conditions impact upon the calculation. Okay, vesting conditions are the conditions that must be met for the recognition of expense. One of the vesting conditions is the performance condition, which could be both
Here it is. Here's like how yellow.
market and non-market condition. Which could be both market and non-market condition.
चलो इसका पेज देखो पता नहीं कितने लेगा रात में मिलेगा तो बताऊंगी चलो अब इसका पेज बनाओ चलो ठीक है नाम पेज अकाउंट के साथ लगेंगे हम ये तो छोटा डॉगी का पेज है छोटा डॉगी का पेज कहाँ है ये रहा छोटा डॉगी का पेज के साथ लगाओ वेरी गुड हाँ साइड पे करो इसकी कार्ड है देखो कैन यू फाइंड द कार्ड वेयर इज द कार्ड
Market condition is the condition to is a condition for the share price of the company to reach a certain level. When it comes to market condition, it's the condition for the share price of the company to reach a certain level, right? The other type of vesting condition is the service condition,
Oh, it's not going. Yes, it will go. No.
according to which
Okay, we will wait now. First, we will see the other thing.
according to which the employee has to complete a certain
Okay, now make a big
period of the service.
big dog. Now make a big dog.
In the current scenario,
The big dog, yes, it's the big doggy's head.
the requirement for the share price to reach a target of $30 is a market condition. In accordance with IFRS 2, the condition is to be ignored. The condition is to be ignored as its impact is already incorporated in the share price in the calculation of the options. The service condition
It is the other part of the head.
is to be considered
Yeah.
and the expense
Head.
shall only be recognized if the service condition
This is the part of the
is likely to be met.
dog.
In the current scenario,
Big dog. This is the other part.
the fair value of the
Where you
replacement award is
Oh,
determined to be 10.8 million, which would mean that investment is recognized at 10.8 million and the equity option is recognized also at 10.8 million. As it as it
turn it.
as at 30th June 2008, a total of
The leg, this part will come here. Now the other part of the leg.
as at 30th June 2008, a total of 4% of the employees
Now where's the body?
a total of 4% of the employees are expected to leave.
Turn.
Hence the
Mm. Okay. Now look. How will you join it?
on this basis.
Yeah.
So cumulative expense to be recognized till 30th June 2008 shall be 100 employees, 100 options multiplied by 10,000 employees, multiplied by $20, multiplied by 96%, multiplied by 4/5 is equivalent to, can somebody suggest how much does it turn out to be?
Will come here. Turn. Yeah. Now where the first one will come? Yes. Will come to the corner. Corner.
So it shall be 15.36 million, meaning an expense of how much dollar? Let's just try 15.36 minus 10.8 million. $4.56 million shall be recognized. Yeah, is that okay to you people? Is that okay to you people? So basically through this specific question, what have we done? We've actually gone through one of the areas that actually talked about the fair value measurement. There was one area where it was actually about the calculation of the goodwill, and with respect to the goodwill, we had both full and the partial goodwill. Then we had third area, and that was basically the determination, the recognition of impairment loss. And that impairment loss was basically allocated to the different aspect depending upon what type of the goodwill was that. And lastly, we've also talked about the replacement award, and we've also talked about the share base. Yeah. Um, glad to hear, Tony. How about others? Are you people okay with all this? Are you people able to understand all this? Whatever that we have done, are you people able to understand? Okay, because this is basically one of the latest mock examination that has been published on the ACCA website. So I am actually going to share the spreadsheet also. And you see, this is how you could actually write down the answers to the question. Yeah, it's similar to the examination. It's very much similar to the examination. It's very much similar to the examination. So let me just print it out for you people. I think I might actually have to do the landscape one for this. No, even the portrait would work out well. I think so, no. Landscape is needed probably because then it would cover up all of them. Okay, let me just see because I think that it's not going to be saved in a clear one. Very difficult question to ask. We have got one more student who was at 49. I'm not naming that student right now, but it's a very, very tough call to be actually failing at 49. I just hope and I just wish that you people are able to get through. Okay, the CB platform is print A to E, no? Right? Yeah, that's what I'm just thinking, Tony. So I am actually gonna just place this here. Just wait a bit. Because otherwise, if I don't do it this way, it will ultimately be very difficult. I'll just copy this. In fact, I'll just cut this. And let's hope for the last question. Okay, I'll think I'll be able to print it now. They have stopped the export button. There used to be an export button which used to actually give even the Excel sheet also. They okay. Yes, I've just actually made it available. So now, anyways, I mean, like, so we have actually done this specific question number 1 of this. Now we are left with 3 more questions. The question which is the question number 1 always takes a lot of time. And that's actually something that actually disturbs a lot in the examination also. Because it's one of those questions that actually has got the most calculations. So now what I'm actually going to do is that I'm going to continue tomorrow. I'm going to continue tomorrow with the remaining 3 questions of this paper. And one of the question is going to be related to the current issue. The other 2 questions are going to be probably one of them is going to be ethics and quality control. And there's going to be one question pertaining to the mixture of various accounting standards. So we're going to continue tomorrow and we're going to conclude the mock examination tomorrow, inshallah. We're going to continue and we're going to conclude the mock examination tomorrow, inshallah. So see you all tomorrow, inshallah. We are going to continue this. In the meantime, there are basically the current issue lectures that I have shared in the WhatsApp group. So you people can actually go through it. Plus, in addition to the session for tomorrow, I'm planning one more long extended session that would start off at 3 p.m. Pakistan time. And that 3 p.m. Pakistan time, 3 p.m. Pakistan time, I would actually I would actually give you people that link. I mean, like it's not planned right now, but I'll just let you know the date so you people can actually come on that specific date, and then we would have a very much extended session also. So thank you very much, all of you. Thank you for being here. Thank you for attending the session. See you again, inshallah, tomorrow.